Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 361 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including interest rates hitting their highest levels since the mid-2000s, what has been a better investment, stocks or property, and an update on the Stop Insider Trading Act. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Happy late birthday, Mr. Jessup. How was your birthday yesterday?
Fabulous. Great day.
What'd you do?
Spent a lot of time with family. Went out to dinner. It was great. Nice time.
Low key?
Low key.
Nice.
Yeah.
Very good.
Another year older.
Yeah, another year older. It was a beautiful day.
It was a beautiful day.
So,
feeling blessed.
Good. Very good. As always, have a lot to talk about today, and we'll start by reviewing the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on July 29th. S&P 500 index down 2.23% for the month and up 6.88% for the year. The NASDAQ Composite Index down 6.13% for the month, up 5.17% for the year. Dow Jones Industrial Average down 1.36% for the month, up 7.35% for the year. The Russell 2000 Small Cap Index down 3.59% for the month, but still up 17.23% for the year. The Vanguard All World X United States Fund is down 2.53% for the month and up 9.61% for the year. 2-year Treasury yield at 4.25%. 10-year is at 4.68%, and the 30-year at 5.21%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, JessupWealthManagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the JessupWealthManagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit JessupWealthManagement.com and book your call today.
So moving on to big headlines, current events from this past week. I think this week's been the busiest week of earnings season so far this quarter, Matt. So had a lot of large companies, some of the most important companies in the world, report yesterday. We got more reporting today with Apple and Amazon after the close. So I think this week is has the potential to drive the next directional move in the market, since we have been in this kind of consolidation phase over the past month and a half for stocks.
Agree. And you have the overhang of the Fed meeting. That news is out there in the marketplace as well. So I think you could be spot on.
So do you want to dive into what happened yesterday with Fed Chair Warsh's second press conference?
Yes. So they voted, the committee, 9-3 in favoring of holding the benchmark interest rate steady mark at the 3.5% to 3.75% for the fifth consecutive meeting for the Fed itself. Now, the FOMC cited solid economic expansion and stable job gains, but noted that inflation remains elevated above their 2% goal. And that was partly worsened by energy price shocks from the Middle East conflicts. Next meeting's in 6 weeks, so that would put it in the middle of September when we'll get another check. It doesn't mean they can't come out in between meetings and change monetary policy. It's been a while since we've seen that, but there are a feeling in the marketplace that this new Fed chair could be one that does more surprise movements between the planned meetings every 6 weeks.
Right.
Want to throw that out there. It's a possibility.
Yeah, and I think, odds did increase a little bit in September for a rate hike. And I think, his first couple of months have been interesting here because I think the narrative coming into it was he is just going to do whatever Trump tells him to do. And it hasn't necessarily been that way so far. I think if that was the case, then we'd see rate cuts actually.
Right.
But it's nice to see that, he's, taking this job, seriously and using the data as a guide. And it's just hard right now with the continued escalations going on in the Middle East.
Yep.
If energy prices stay elevated for a longer period of time, then there's not going to be a whole lot of justification to lower rates, right?
Yeah, you said it perfectly. And I have a piece on interest rates coming up that I find interesting. I think it's a topic in the market that's not getting enough attention.
Okay. Well, moving on to those pieces of research, the first thing I have is a post on X from Mike Zaccardi on July 22nd, and he was using BCA research from Doug Pita. He says stocks have outperformed houses significantly over the past 5 decades. So Jenna will throw this chart up on the YouTube video. It'll be in our show notes. But what this shows is the comparison of returns over the past 50 years of the S&P 500, the S&P 500 total returns, which includes dividends, and then the Case-Shiller National Home Price Index. So there's 2 different charts within this graphic. The top level is what we call nominal returns, just returns not accounting for inflation. And then the bottom portion of this graphic shows real returns, which does account for inflation every single year. So I'm just going to quote the numbers for the real inflation adjusted numbers here. So S&P 500 total return annualized over the past 50 years, 8.3%. The S&P 500 without dividends, 5.4%. And then the Case-Shiller National Home Price Index, 1.4%. So pretty stark difference over the past 50 years. And I think the argument that some, real estate lovers will have is, well, you're just comparing to the last 10 years or the last 15 years when the stock market has done really well. And this data is going back 50 years. So I think it's pretty hard to argue with this. Now, I know, when you own multiple properties, you have a lot of income coming in the door. So I guess it's not a exact apples to apples comparison.
Could involve leverage.
It could involve leverage, right? So there's a lot of different things that can influence this. But I just thought it was interesting because I've heard the argument several times before that, investing in the stock market is like gambling. It's funny money when you compare it to quote unquote what people say are real assets like property and housing and that type of thing.
Yeah, I think it's I think it's a great point.
So what are your thoughts?
I think it's spot on. I think that real estate has its place for, certain people's risk tolerances and, their desires for diversification. I think those things have places, but I think also if you're looking at it from a rental standpoint, being a landlord is a whole nother ball of wax. And I think most people romanticize having, owning real estate until they actually have to manage it, if that makes sense.
Yeah. Or you have to hire someone to manage it and then your margins go down.
There you go.
Right, which eats into your return.
You just got to know what you're getting yourself into. It's different when you can, hire a professional money manager that's managing your, liquid investment portfolio, and you don't necessarily have to have that hassle factor involved.
Yeah, and I would argue the barrier to entry for the stock market is a lot easier than real estate, right?
No, that's another great point.
You could have someone that's making $1 million from rental income, whether it's commercial or residential.
Yep.
But you have to have the capital to outlay to be able to get that income,
Great point.
right? And
Great
for
point.
the stock market, all you have to do is open up a brokerage account and contribute $100, and you're in.
Great point.
Right.
Yeah, great point.
Second post I had was from Blue Kurtik, Market Insights. This was on July 23rd on X. So they said, bulls maybe skip this one. Only 7 times in the last 20 years have the S&P 500 and the NASDAQ 100 ETF gapped down over 1% at the open, while oil gapped up over 5%. 6 of those came right before big drawdowns. 1 came right before a recovery. We'll find out soon which bucket this joins. So again, Jenna will share this on the YouTube page. It'll be in our show notes. And for all of those people who say Matt and I are just bullhawks on this show, this is a piece of negative research that I'm showing. So I just thought it was interesting given what's going on in the world right now. Obviously, like I mentioned a couple moments ago, tensions have flared back up in the Middle East. Oil has been on the rise significantly since the beginning of July. I think it's up close to 25-30% just this month alone. So this stat isn't necessarily surprising to me, but it is interesting that it comes before some big drawdown. So it was right before, we had the drawdown in 2011. It happened, in 2020. 2022, it looks like. So there has been precedence for this, but the sample size is relatively small. I think we're going to learn a lot over the next month or two, knowing that August and September tend to be weaker months for the market, and then the fourth quarter and the beginning of next year historically have been strong. We'll know pretty quickly which way this market is going to go, but again,
makes you wonder some of that fall volatility is getting pulled forward.
Yeah. And that's the interesting thing about this year. It feels like everything's getting pulled forward by just a few months, right? So we had the big sell-off in the first quarter of the year. Typically in a midterm year, you get a lot of weakness in Q2 and Q3. This year, Q2 was really strong. Q3, starting off, not so much. So that's the funny thing about seasonality, right? Is that's why we don't use that solely to make investment decisions.
Absolutely.
Right? Or this would be a really bad year. It's just a tool in our tool bench that we use to generate our overall market outlook.
So whenever I see the tape acting this way over the past month, I always go back to the fundamentals in my eyes. And I'm always thinking, are the fundamentals underneath the surface of this market, are they getting better? Are they stable, staying the same? Or are they deteriorating one way or another? And I would argue for a lot of stocks, they're either stable or getting better. So that, in my opinion, will buoy any sort of prolonged weakness, because at a certain point, the earnings reports would speak for themselves. So I do think it's going to be interesting as we come and look at the second half of the year. Investor sentiment tends to move in these quick movements. I'm going to talk about that here with one of my research pieces. And just as short-term bearish the market is, Mark, we could be sitting here in 6 weeks and everyone is just buying stocks, gangbusters, and everyone's crazy bullish like they were just 5-6 weeks ago. And if I were going to throw some money on the table, I'd probably speculate we're going to see it pendulum swing the other way.
Yeah, I would agree too. And me and you were chatting earlier before this, and it's not a recommendation for or against this name, but Microsoft reported earnings last night.
That's a good example.
The market closed. Yeah. Has been just battered since the fall of last year.
Yeah.
So almost going on a year now.
Agreed.
People are very, very pessimistic on software right now. Very pessimistic on Microsoft, and no one has been talking about them as being a large portion of their portfolios. And what do you know, this morning, I don't know what's going on right now, but the last time I looked this morning, they were up 9% pre-market.
And what caused that? The fundamentals.
Right. Fundamentals are haven't gone anywhere for a long time. And with a company with a history as long that Microsoft has, you can go back and look and see every time that Microsoft was this far below its 200-day moving average and the valuation was this cheap and the earnings growth was this, the revenue growth was that, their margins are this, nothing's wrong with the company, but it's getting sold for some reason. Throughout its entire history, it's been a generational buy. And I'm not saying this is the case for Microsoft this time, but
yes,
with a company like that, you have history to go back and look at, okay, what happened during similar instances.
And see, that's a great example, Mark, because you went into detail why the fundamentals matter. And if you just look again at the narrative of the market over the past month, you had a lot of enthusiasm and euphoria in the market in the second quarter. There were definitely areas of the market that got ahead of themselves. And even Aaron and I were talking about on the podcast just several weeks ago about how a lot of these memory stocks were just going gangbusters. And the comment that Aaron and I had on that piece was, well, the underlying earnings are there. It's just a question of how long they last. Well, you come back to, again, a lot of these stocks in the market, and I'm thinking to myself, okay, take the technology stocks aside, a lot of earnings are stable or getting better. And that will help buoy any sort of prolonged weakness.
Yeah,
and Microsoft example is a good one of that.
And you've seen that. I mean, tech has been the weakest sector so far in the second half of the year, but there's been rotation in the market where all the other sectors are starting to pick up the slack, and the market's doing just fine, and we're just a couple % off of all-time highs.
That's the funny part, Mark.
Right.
Like, what are we off? We're off, I'm going to spitball, no more than 5% from an all-time high for the S&P, and we're acting like we're down 17, 18%.
Right. That's just how the market works these days, unfortunately. So last thing I had was just a piece that was in the media cycle here over the past week. The House of Representatives passed the Stop Insider Trading Act bill on July 22nd. But it does still need to be passed in the Senate. So just a brief overview of what this does. Congress members are prohibited from purchasing new individual stock positions. However, they can continue to hold individual stocks that are already a part of their portfolios. This does apply to Congress members' spouses and their dependent children.
Bunch of divorces are coming.
Yeah, right. So
my jaded on both sides of the aisle.
Right.
Sorry.
Right. So before selling an individual stock, they must give a 7 to 14-day notice. And those who don't face a $2,000 fine or 10% of the trade, whichever is greater, which is a much heftier penalty than the $250 late filing fee that they get banged with right now. So, it's no secret that both parties do this. All different levels of Congress does it. We've talked about it before on the show. It's amazing to me how people haven't been thrown in jail for insider trading, but this is a step in the right direction. And I know that there's people out there that say it's too punitive or it's not punitive enough, and there's still loopholes to get around this stuff. I think the fact that they're talking about it is a step in the right direction, but I just wanted to bring it up because it's been a popular headline topic.
It is fun to watch the trades.
It is, yeah. And a lot of times these people have phenomenal track records.
It is interesting how often I get the question or comment from a client about, does your firm track, the trades by politicians? And I'm like, Mark is watching those things.
I am. Yeah. I subscribe to different research pieces. There's a numerous amount of tools out there that you can use to track this stuff. And there's a handful of politicians that are really, really good.
It's amazing how accurate they are.
Right? So everyone, their first question when I start talking about this is, well, why aren't we doing exactly what they're doing? And it's like, well, the way the regulations are written right now is they don't have to announce the trade right when they place the trade.
That's right.
And they can announce it 8 months later and pay $250 and say, whoops, I forgot to file it. Right? Yep. So it's not as easy as people make it sound.
I agree with that statement.
So we wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
My first piece, Mark, is about interest rates. So I feel that this is not getting enough headlines. Let's face reality. You got some upward pressure on longer maturities right now on the 10 and the 30. So I'll verbalize, Jenna does not need to put up this initial chart. It's going to show the 30-year Treasury yield, and it goes back quite some time. The reality is the 30-year Treasury yield is over 5% at the highest level, as you mentioned, since the mid-2000s. And that's putting a lot of pressure on bonds. You talked about it in the podcast, even over the past 6-8 weeks, that this could be a tough move for bonds here. And as interest rates move higher, what happens to bond prices, Mark?
Yeah, they fall.
So there was a piece by a journalist, Carl Cantanilla, and he was referencing a J.P. Morgan quote, and the timestamp on this was just over the last couple of days. And J.P. Morgan said, quote, "During Warsh's term, if he lasts as long as prior Fed chairs, he will preside over the dreaded crossover point. In the year 2031, Mark, it says, entitlements, interest, and other mandatory outlays are projected to permanently exceed federal tax revenues for the first time." Now, this chart, I do want Jenna to put up for our YouTube viewers. This will be in our show notes. And it's a visual by J.P. Morgan that is graphically showing that. Now, why am I highlighting this? I think at times the market is thinking to itself, okay, well, the government's continuing to spend a lot of money it doesn't have. Yields are at a high point. Do I want to take the gamble right now on a 30-year bond? Or if I'm a long-term investor, would I rather own part ownership in a steadily growing stock? That's a tough thing to trade off.
It is.
And if people can weather the volatility of stocks, they might become more appealing. But I think the pressure on yields right now is an under-discussed headline right now in the marketplace. And you watch, it'll be like clockwork. If you start to see rates come down over the next month or two short term, it wouldn't surprise me to see stock prices to follow. Any comments?
Yeah, I think this could apply to what's going on in the housing market right now as well. You're seeing a lot of downward pressure on housing prices because supply is increasing. And I was talking to my mother, Taylor and I were talking to my mother-in-law yesterday, and she lives in Florida, and she said it's the most amount of supply that they've had in her area in 20 or 30 years.
Wouldn't be surprised.
So now you have this situation where supply is way up, pushing prices down.
Yep.
But
affordability
yields are continuing to go
hurt
up.
Affordability.
So it's like all these people, and I'm specifically talking about younger people that are like first-time home buyers, right? They finally get to the point where there's downward pressure on pricing, but now the cost to borrow that money to buy the house just continues to go up and up. So it's like they're getting it from both sides of it right now.
Yeah.
It's just, it hasn't seemed to let up since close to 2020 or shortly thereafter.
Good point. Good point. Another thing there, though, you start to see downward pressure on rates. It probably will perk up those prices in real estate. Wouldn't surprise me to see that correlation, right? My next piece has to do with some panic selling on my birthday yesterday. There was a data piece that caught my eye from Bar Chart late last night. Retail investors dumped stocks yesterday at their fastest pace since COVID. And I found this quite interesting. When I tend to see this type of data, they tend to be at or near turning points in the market on both sides. And with the selling pressure so extreme, that means that, in my opinion, retail investors are becoming emotional and they are becoming very short-term fixated. And that tends to be a recipe for a turn one way or another. Just my years of experience, just throwing it out there, doesn't guarantee it. Any questions, comments before I continue?
No, I mean, it looks like the biggest inflows since COVID were early in 2025, so January, February, and we all know what happened shortly after that was Liberation Day.
Right. It was,
and
it was
the
a
market fell.
tough slug last,
Right.
March through end of April was tough in 25.
Yeah, so these type of things do tend to, like
Be
you say,
contrarian indicators.
correct.
So my last piece, just to kind of throw this out there, this just adds to what's going on underneath the surface of the stock market in certain areas. There's a piece by Hedgeye that caught my eye on July 28th. It has to do with this. Goldman's high beta momentum basket is on track for its worst monthly performance in history. Worse than 2000, worse than 2009. Again, monthly performance. This piece by Hedgeye is indicating that the Goldman Sachs U.S. high beta momentum monthly through July 28th was down over 37% in a month. Now, I'm not going to reference the exact stocks that make up this basket, but let's face reality. A lot of these names have been the hot names in the market earlier in the year. Some have good fundamentals, some do not. And they're obviously the hotly traded stocks, and the air came out of that portion of the market here in July in a big way. So that could be part of the reason you got this short-term negative sentiment, Mark, let's call it. But this to me is just one portion of the stock market, right?
Yeah, and I think it's important to kind of highlight how beta works. So beta kind of measures certain stocks' volatility, I would say, relative to the market. So
Keep going.
if a stock has a beta of 1, it typically moves in pretty much lockstep with the market. If the market's up 1%, the stock's up 1%. If it's down 1%, stock's down 1%. But if you have a beta of 2, then it, for every 1% move in either direction for the S&P 500, it's a 2% move for the stock, and so on and so forth. So these are high beta names that are a lot more volatile than the market,
than
right?
the stock
so
market
when
in
times are
general.
good, they're rocking and rolling and up significantly. But when you have pullbacks, and especially with the high concentration in tech that the S&P 500 has, a lot of the high beta momentum names are what? Tech.
Yeah, and it was,
and those names have been hit hard over the past couple of months.
they have. Again, I'll go back to that podcast me and Aaron were on. I want to say it was about maybe 3 weeks ago, roughly. And I just threw out the comment. Everyone was talking about the memory stocks, the subsector of semiconductors. I just made the side comment to Aaron, hey, the market tech sells off 10%. Those stocks are going to be down 2-3 times that. And now you're kind of seeing that play out in July. And, again, that pendulum could swing. And if the market rebounds, you could see outperformance from those stocks. But let's face reality, they're spicy. You just got to have the proper risk sentiment, goals, and objectives to be in those types of high beta stocks. It could be a risky proposition for a lot of investors if that's all they own. So be careful.
Everyone
be careful.
loves the upside.
That's right. Just be
But
careful.
if they're high beta, they can be just as high beta to the downside.
You can only take so much wasabi on that plate. baby.
Right, exactly. So, well, I will give my seat to Taylor for her to talk about the financial planning topic of the week.
All right. Thank you, Mark. So next up is Taylor Ledbetter. She handles our firm's financial planning work, and she comes into the podcast from time to time with the financial planning topic of the week. Miss Taylor, how are you, and what do you got for us?
I'm doing good this morning. The topic I'm going to talk about, so I'm going to reference an article written by Toby Nelson.
Okay.
And it's titled, Where the Down Payment Burden Has Grown the Most.
Well, look at the correlation here.
I know.
Mark and I talking about real estate unknowingly to us, and you blend right perfectly in. I'm not
Yeah.
surprised, Taylor.
Yeah, definitely ties into everything you guys just kind of talked about.
All right, I'm in.
So the article just starts off by saying saving for a home down payment has become a moving target. As rising home prices outstrip wage growth, the amount of time buyers need to set aside enough money has changed sharply in many parts of the country. So, Smart Asset, they basically ran a study and compared home values in 2016 and 2026, and then compared that with the median household income for each state.
Okay.
So, their goal was just to estimate how many years of savings would be required to afford a 20% down payment,
Okay.
assuming a household was setting aside about 10% of their annual income.
I'm intrigued.
And they also did an evaluation to see how long it would take a minimum wage earner to save up for the same thing in 2026.
Okay.
So I'm going to go over the key findings and then I'll talk a little bit about the Ohio data last.
Sounds good.
So Idaho had the largest increase in time needed to save for a down payment. On average, it would take median income households 11.2 years to save up a 20% down payment for a home. I was a little surprised that Idaho had the largest increase compared to all 50 states.
It's interesting. You think, I've heard different news snippets, Taylor, that with some of the exodus from some of the high-tech states like California, there's been a lot of migration to states like Idaho. And I'm going to speculate this has had a direct correlation to their real estate prices. I'm speculating, but the data kind of feels that way. And imagine you're one of those people saving up, and then you had this influx. Prices are going up, and as you're kind of indicating, that down payment keeps getting stretched out farther and farther that you need.
Yeah, and I do think it's less common today to maybe put 20% down.
Another good
I
point.
feel like that was kind of the old
Another
rule
good
of
point.
thumb.
Another good point.
Another key finding is that pricey coastal states still require the most time to save for a down payment.
Yep.
So states like Hawaii, California, Massachusetts.
Yep.
West Virginia has the lowest down payment burden with about 5.5 years to save for a down payment in 2026, which is only 3 months longer than 2016.
It's wonderful.
In 3 states, median income households can save for a down payment faster than they could in 2016, and that includes Mississippi, North Dakota, and Louisiana.
I'm intrigued. Interesting.
I know. I thought all this was really cool data to kind of look at.
Yeah.
And then last, saving for a down payment on a minimum wage income alone is essentially impossible in every state. Even in Missouri, which is the most favorable state, a minimum wage earner would need 17 years to save a 20% down payment.
Interesting.
Which is really sad when you think about it. But again, that kind of goes back to people putting less down.
Yes.
Now, in regards to Ohio, so in April 2016, the typical home value was just under $128,000, and the median household income was a little over $52,000. Compare that with today in 2026, a typical home value is just under $245,000, and the median household income is just over $76,000.
Wow.
So as of right now, it takes about 6.5 years in Ohio to save up for that down payment, which is about 19 months longer compared to 2016.
Interesting.
So yeah, I just wanted to kind of touch on that today. Just talk about, the time it takes to really save up for these things and just the difference that 10 years can really make.
I think it's a great piece that you picked, and I think it melds really well with the conversation Mark and I were having earlier about real estate. I'll be really curious, Taylor, how interest rates go the rest of the year, and if we start to see some downward pressure on those rates for whatever reason as we go into the fall, I'll be curious if there ends up being a direct correlation to real estate prices. That'll be fun to watch.
You would think there would be.
You'd think there would be. Good piece, Taylor. Anything else you'd like to share with our listeners and viewers before we sign off for the week?
No, I think that was everything for me.
Well, just another quick reminder, it is the heaviest week of earnings reports, listeners and viewers. So if you see some larger movements on some individual stocks that you might track, could be a good reason either them or a close competitor's reporting earnings and the market is digesting that news. And thank you for listening to episode 361 of the Independent Advisors Podcast. Catch us next week for episode 362. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.